Good evening, Professor Jesus Alberto and students. Today we are going to present about Treasury bonds. The members of the group are Xiomi Ordóñez, Renato Otazu, Andrea Ríos, Christopher Villano, and me, Juan Diego Rodriguez. Next slide, please. So first of all, we're going to talk about the definition of public treasury. Well, according to the Ministry of Economy and Finance, public treasury is securities with debt instruments issued by the government of different countries. These titles can be bills, bonds, and obligations. Next slide, please. Some of the requirements to do public treasury are the fiscal or treasury administrations. Is a set of organs of the administration of the state in charge of delivering economy resources to its coffers, as well the instruments with which said states manage and collects taxes, then encompassing both income and expense, which implies both the planning of taxes and other states' income, such as public prices, lotteries, penalties, as well as the preparation of the state budgets for approval by the corresponding body. For example, Congress, parliaments, or others. Finally, public finance normally depends on the Ministry of Economy and Finance, although this depends on the government's organization chosen. Next slide, please.
Hi, I will explain definition of treasury bonds. Treasury bonds are defined as United States government debt securities with a maturity of more than 10 years but less than 30 years. Treasury bonds paid a fixed rate of interest each year. They pay semi-annual interest payment until maturity, at which point the face value of the bond is remunerated to the title holder, and the income received is only taxed at the federal level. Investors receive a face amount of the bond maturity, and in the market, the price of a treasury bond might be higher or lower than the face amount, depending on the rate paid by the bond compared to the government. For this cost, treasury bonds are generally considered risk-free investment owned by the lack of non-payment risk and extremely high level of liquidity. Treasury usually offers the lowest profits of bonds with a similar maturities and are considered benchmark of the fixed income assets class. A fixed income asset is one of the pays and exact interest income to the investor over a specific period of time. Treasury bonds are issued monthly online auctions held directly by the United States Treasury, and a bond's price and its profits are determined during the auction. After that, they are traded actively in the secondary market, and it can be purchased through a bank or a broker. Next slide, please. Okay, talking about the history of treasury bonds, according to the U.S. Department of the Treasury, the first U.S. Treasury bond were originally called Liberty bonds. They were issued to supply World War I in 1917. The first Liberty loan authorized the issue of 5 billion worth of bonds at 3% interest after 3 weeks that the United States declared the war on Germany. Well, the United States government increased income taxes to finance the cost of the war. So after that, they call them like war bonds. Traditionally, the government borrow from another countries the money, but after that, they came with this idea. The Treasury raised funding through the war by selling a lot of money. These bonds were sold at subscriptions where officials create coupons price and then sold it to pay each downly fully in a limited batch surplus. To solve this problem, the Treasury refinanced the debt with variable short and medium-term maturities. Um, well, uh, after this complication, it was kind of the organization suffered from oversubscriptions where interest rates were so popular that there were more purchase of debts than required by the government. So finally in 1929, the US Treasury removed them, um, the, the subscription system, and they solve it by the highest buyer, and securities were then issued on a professional system where it will be assigned to the highest bidder until the demand was complete. Um, More of the treasuries were supplied by the government, and they will then be assigned to the second highest bidder. Uh, Next slide, please. Characteristic of treasury bonds. They are paid semi-annual interest. It is usually used to preserve a portion of their retirement saving, riskless, to provide a solid income in retirement, or to save money for education for kids or adolescents. And they have a maturity of 10 to 30 years with a minimum face value amount of $1,000. Although both of there are sold in 100 increments in purchase directly from the United States Treasury. Trade really in the capital market. If the market driving yields higher, this pushes the price of the bond lower. It makes the lower yielding bond or less attractive investment. Investor must hold their treasury bond for at least 45 days before they can be sold on secondary market, and that's because longer terms bonds usually have higher profits and they are riskier. Thank you.
Um, I talking about why are treasury bonds issued. Public treasury bonds are medium and long-term debt instruments which are used mainly to finance different state-based investments. For example, if the government wants to carry out public works project, such building a highway, it issues treasury bond to obtain capital or the money necessary to finance this infrastructure project. The case of the treasury bonds in the security, they make the probability of default the lowest in the local market. In the case of Peru, from 2004, treasury bonds are known as sovereign bonds. Um, in Peru, the characteristics of treasury bonds tend to be short, medium, and long range. Of the last ones are 20 years or more. Therefore, there is a certain number of sovereign bonds in force as of October 2020, presented by the Ministry of Economy and Finance, and it can be seen the oldest was issued in 2005, and the last expiration year will be 2050. Treasury bonds in the crisis 2008-2009. In 2008, there was one of the largest crises in the history of financial markets. The international financial crisis, um, the international crisis has a background, the errors of policymakers, the regularity, flexibility of macroeconomic policy authorities that led to practice irregularities in the real estate sector, in the stock market. In addition, the Fed reduced the interest rate to 1% in 2003, thus boosting credit, which added to the lack of the regulation in the financial market for mortgage loans. Financial institution granted loans without applying filters and studies necessary for each applicant. Subprime mortgages arose that were high risk loans. The rating agencies gave AAA grade to securities that did not have that rating. According to Ponder, when QA or quantity easing one was carried out with purchases for mortgage debt, the monetary authorities bought long-term treasury securities of $300 million over 6 months, with the aim of reducing the interest rate on loans, mortgages, and provide a greater possibility of crediting to home buyers and grant better conditions to the financial sector. For QE2, long-term treasury securities for $600 billion with were purchases to have greater economy activity, keep mortgage rates low. However, interest rates rose more than expected. To finally, one of the action that the Fed took was to sell treasury securities for $400 billion that will maturity in 3 years and then reinvest them against insecurity with a maturity for 6 and 13 years.
Okay, how are Peruvian treasury bonds issued? According to the central bank, the bonds are securities with credit context and represented by a book of entry freely negotiable. They are issued by the Republic of Peru and is represented by the Ministry of Economy and Finance, the MEF. Also, the Treasury Peruvian bonds are medium and long-term fixed income securities. They represent direct, general, and unconditional obligations of the government and are mainly issued by 12 actions. Their instruments are denominated in nominal national currency and have a maturity of 36 months. And it's really negotiable. It has different points that they must consider when they are going to have a Peruvian national bond. So you have natural peoples that can acquire this bone treasure Peruvians through a SAP system, and there are eligible entities. And the secondary market with a great liquidity, they have individual represents that has 1% of the total outstanding amount, that these are the bonds that may consider in Peru. The next one, please. So in this case, we're going to talk about issuance of Peruvian bonds by currency and maturity. The first one, according to Bloomberg, the issuance of Peruvian worldwide bonds arrived at $6.4 that was in 2016, and the administrations of Peru gave $2.5 in worldwide bonds, including in soles 4.2, and the Peruvian News Soul named the bond due to the 2020 as a 40-year sovereign bond that the Peruvian corporate sold 3.9 US dollars. And we can see in this chart the bond debt by currency, which is 103.513 soles. And the next one, please. In this chart, we can see by the currency, the residual maturity, the yield, the bond price, and the different coupons rates between 1% and 9%. The term to maturity of the bonds will be one of that actually exists between the settlement date of the transaction resulting from the over of the bonds in the framework of the actions carried by the responsible unit, and it's resulting a good negotiation that could carry out a centralized negotiation mechanism authorized by the date and the redemption and the residual majority of the respective bonds that we can have.
Good day, teacher. As mentioned, as we know, according to the MEF, bonds are securities with credit counter registered, represented by book, entry, and freely negotiable. They are issued by Republic of Peru, represent of MEF, Minister of Economy and Finance, and through the General Director of Debt and Public Treasury. Bond issued locally are called sovereign bonds. According to what is specified for treasury bonds are two according to the holder, residents and non-residents. One on side are the residents who are natural or legal people whose center of economic interest in the country of reference, like with in the balance of payments, any institutional unit, mainly companies and families, whose center of economic interest is located in the territory of a country is considered a part of this group. Also, the center of economic interest falls within a country when there is a place in which or from which economic activities and transactions are carried out on a significant scale, indefinitely or for a definitive but prolonged period of time. Generally, the economic activities that the residents are carried out and during a period of 1 year or more define a center of interest and therefore the quality of residence for which they carry out such activities. However, the 1 year period is only a reference and is not a flexible rule. On the other hand, well, it's the non-residents and are also natural or legal persons who are interested in the economic interest of the country of the holder. But the difference is that they are not operating for a permanent establishment in Peru, in this case. Please. Well, also these holders are for residents and non-residents can classify in different ways. No, maybe the residents can be AFP, insurers, public fund, private fund, natural person, or national banks. However, these holders can classify in different ways of according to RMF. Among these are by institutions, terms, currency, well, among others. Please.
Okay, so as a conclusion, we conclude as a group that public treasury, it refers to the branch of economic knowledge that aims to study the economy of the public sector. And this includes the intervention that the state carries out in the market economy, mainly through public income and expenditures. This, for instance, treasury bonds refers to United States government debt securities with maturity of more than 10 years, but less than 30 years. This pays a fixed rate of interest each year. In 2008, we got one of the main crises in history. This crisis had as a background that errors of policy markets and the regulatory flexibility of macroeconomic policy authorities that led to practicing irregulation in the real estate sector and the stock market. So finally, in Peru, we got a certain number of sovereign bonds in force of October 2020, presented by the Ministry of Economy and Finance. And it can be seen that the oldest was issued in 2005. And the last expiration year will be in 2055. This investment required is not to consume the good, but rather to use it in the future to create.
Okay, my contribution for this analysis is that I believe that an administration bond is given by a public government and is designed in the nation's growth, and also that the bond gave a public government and a familiar monetary standards that regularly is allowed to a sovereign bond. I think Peru can issue for giving it must be capable and limit the effect of the monetary shortage. And the administration is and investigate the chance of giving green securities or protections connected to social and supportability ventures as the chosen ones. And I think that Peru sold this is designed due to the to increase due to the 2029, and that's my contribution.
In my contribution, I think that public treasury bonds for any country is a fundamental tool to invest in public works when carrying out public works that can be construction of roads, hospitals, ports, schools, mean of public transports. The quality of life of the population is increased. In addition, the government receives money that will be used for investment, increasing consumption, increases economic activity in the country. On the other hand, in order for public works to be carried out, the state needs a company that provides this service. That is, it will generate employment, new jobs, more people working, the low unemployment rate, and due to the relationship inversely with GDP, the level of the GDP of the economy rises. That is why public treasury bonds are very important in the economy of a country. Thanks.
My contribution is that they are usually used to preserve a portion of retirement saving riskless and provide a solid income in retirement, or to save money from some situation that money from work isn't enough, like a master or a new house, education, university. Also, they pay semi-annual interest. So as a matter of fact, treasury bonds have been helping people to have a better economy.
Okay, so my contribution in this work, public treasury are very important to invest in their country. The investment required is not to consume the good, but rather to use in the future to create wealth. So the government receives money, and this will be used to create consumption and to increase economic activity. As a result, it will generate income, more employment, and the economy will rise and a low unemployment risk.
Well, in my case, it's quite important to know about the treasury bonds. The types fund that are as well certain companies that are classified according to whether if they will be residents or not residents. Like this, the type of investment they make, if it's the local or maybe abroad.